Hello and welcome to the 18th of our ACCA F5 lecture recaps. This session was on standard costing by way of introduction to variances, which we'll be looking at next time. So standard costing, what is it? It's an estimated cost per unit at its simplest level. So really we're thinking about material costs, labour costs and overheads. We're then going to compare that estimated cost per unit to the actual cost. We're going to highlight the differences and we're going to call them variances. So the difference between our estimates and the actual cost is going to be our variances. It's very useful in manufacturing where it's highly important that you get your costs right and your sales price right. So you need to be able to highlight any differences between your estimates and your actuals so that you can rectify them straight away. So how do we do this? Well, to derive standard costs, what we do is use different data. So for example, for materials, we might use the current price, or we might use forecasts to decide what the estimate for our materials cost will be in the future. For labour, well, we'll know our pay rates, so we'll know if they're going to change, and we can estimate those. For overheads, we may use historic data. So types of standard cost. First of all, you'll have a basic standard cost. This won't change over the years, so this is way back at the start, your basic standard cost. This will help you identify the long-term trend in prices, usage, whatever it happens to be. Your current standard cost will be based on conditions at the time. This will be the most relevant. It'll be based on conditions at the time. Attainable standard costs, these are realistic. So really, best case scenario, these will form the basis of your costing. They're realistic and attainable. An ideal standard, well, this is the best possible and it's probably unattainable. So it's something that you could aim for, but it's probably unattainable. When it comes to other aspects of standard costing, things we need to be aware of, flexible budgets. We mentioned this previously. This is a budget that should be able to respond to changes. So we're thinking about separating out our costs first of all, then looking at a total budget for each one. So separating out, say, your fixed costs, your variable costs, getting a total budget, and then flexing it. So maybe saying, well, if we meet 100% of our expectations, what will the budget be? If we meet 80%, what will the budget be? And again for 70%. So a flexible budget will then enable you to say, right, what's going to happen if we do this, if we do that. When it comes to performance, the budget must be flexed, okay? It must have a little bit of flexibility in there for uncontrollable things that management can't deal with. It ensures comparability, okay? So it ensures that you're comparing like with like, what you could achieve with what you did achieve. Problems with it, well, separating out the costs can be difficult. There may be stepped fixed costs. If you look back at your F2 data, stepped fixed costs may occur. Use of judgment, there'll always be judgments when you're using flexible budgets. So it'll involve the use of judgment, which can be a problem. It can also lead to moving targets. So remember that management will be motivated if they've got targets that they feel they can achieve. And having a flexible budget means that you may be moving those targets. A couple of definitions we need to be aware of before we get into variance analysis. Materials wastage. Materials wastage may occur due to spillage, evaporation if we're talking about liquids, or breakages. So that's what materials wastage is. Idle time, well, this is gaps in production. So this may occur because there's no work available for the workers to do, or maybe due to a machine breakdown. Controllability is a very important aspect. We touched on it when we looked at budgeting, but it's very important for variance analysis. The concept is that managers should only be responsible for costs that they can control. There's no point in putting managers in charge of costs that they have no control over. They'll lose motivation and they can't then deal with the budget properly. It ties in with responsibility accounting that we talked about. So how do you use this when you're doing a question on F5? Firstly, you need to determine who ultimately controls a cost. So if you're given details in a question, determine who ultimately controls the cost, and they should be responsible. So put them in charge of that particular cost. So that's our standard costing, our introduction to variance analysis, which we'll look at next time.